A very good evening, everybody. It's good to have you guys all with us here today. I hope that you all had your dinner. For those of us at ProsperUs, we will be having another late night, but we are excited to be talking about the market outlook for this year with various speakers on board today. Now, I'm Billy. I will be your moderator for today's event. Now, with us here, there are 5 speakers. So I'm just going to give a brief introduction to some of them. Tim is our head of content and investment lead. He will be sharing with us on the US market for today. Saibun, he is the CGS-CIMB's Melbourne-based Chief Investment Strategist, and he will be talking about the macro outlook. Now, for those of us who are interested to see how we can navigate investment amidst a US inflation that hits 39% high of 7%, that will be something interesting to watch out for. Samuel, he is our market specialist, and he will be talking about the Hong Kong and China market. Now, Sexiang, he is the head of retail research at CGS-CIMB, and he will be sharing with us on the Malaysian market, followed by Man Yi, who is the deputy head of Singapore research. She'll be talking about the REIT'S market specifically. Now, without further ado, I'm just going to pass the time to Saibun to start off the presentation on macro outlook. Saibun, over to you.
Thank you very much for the introduction. Thank you so much, and good evening, everybody. Thank you for joining us today. So let me get straight into this by sharing my slides with you. Right. Okay, so we are ready to go. So the good news first, all right? A bear market is unlikely at this stage. For the US market, the yield gap between the next 12 months earnings yield minus the 10-year US Treasury yield was 311 basis points at the time when I prepared this presentation. So it is around about 300 basis points at the moment, because we had a little bit of a rise on the high inflation numbers released by the US authorities a couple of days ago. Now, notwithstanding that, you do not typically get a bear market when there is still that sort of yield gap in favor of stocks. Now, looking at it from a trailing 12 months basis, so that's the chart you've got on your screen there. On a trailing 12 months basis, the yield gap when I prepared that chart was 247 basis points, say 250, versus the long-term average of 70 basis points. So it's still a lot higher, meaning it makes more sense to still be in stocks. Now, before the global financial crisis, the trailing 12 months yield gap fell below 100 basis points. And before the NASDAQ crash of year 2000, that gap went deeply negative. And we also see decent yield gaps favoring stocks in most of the other markets, as you can see on your right-hand side. That's the table on your right. Okay, let's move on to the next slide. Yes, but we have to expect much lower returns in general for this year, particularly for the US market, where economic growth and earnings growth have peaked and are turning down. Now, at some point this year, we could see negative year-to-date returns. We could. For the full year, I'm expecting still positive returns, but small. Okay. Now, the big news last week was the Fed hinting it might start hiking rates. It might start rate hikes immediately after the taper, and then commence net selling of their assets shortly after that. So we've seen a ratcheting up of interest rate expectations through the course of last year. By the end of last year, the market was expecting 325 basis point rate hikes for this year. Now the market has moved pretty rapidly to price in 425 basis point rate hikes for this year. And then a shrinking of the Federal Reserve's balance sheet with a pullback in M2 money supply. Now, all of that is going to likely overhang stock prices. Okay, and then you've got to deal with the fiscal impulse. The fiscal impulse will fade as the US government attempts to repair the biggest budget deficit as a percentage of GDP in US history since the Second World War. So we are cautious and we are selective on the US market now. It's pretty much fully priced and rates are rising. So the valuations are not cheap, yet rates are rising. And rates are important because rates are the discount factor for valuation. Now, Europe and Japan have better prospects for this year. And key to that are their lower inflation rates and their more dovish central banks, which means that they will have better chances at keeping their rates and yields at zero for longer. Now, the chart on your left shows the relative performance between world growth stocks versus world value stocks. That is the MSCI World Growth Index versus the MSCI World Value Index. Now, you can see that we've seen a peaking of growth versus value. Now, growth stocks are dominated by tech stocks, and the US market has the largest representation of tech stocks in the world. Now, growth stocks or tech stocks are past their best days for this cycle. As you can see from the chart on your left, we've seen a peaking of that sort of relative performance and a turning over of growth versus value. So we have pivoted to value stocks. That's my view anyway. And Europe and Japan have better representation of value stocks in their indices. And it's this value theme that could drive outperformance for this year for European and Japanese equities. Now, as you can see on both PE and PE to growth sort of metrics, that's the table on your right, price to earnings and price to earnings to growth, Europe and Japan look more defensible than the US. And indeed, let's go back to those lower rates and government bond yields in Europe and Japan. These markets show even better value for those when those valuations are adjusted for the risk-free rate, because they have lower government bond yields, 10-year government bond yields. Next to China. Now, China has had a torrid year, a bad year in 2021, but we may be past the worst for Chinese stocks. The CSI 300 index, which is the one that you see on your screen there, the CSI 300 index has been base building in the 4,800 region. Now, from a value perspective, since we are on this value theme, Chinese stocks have been oversold. And as you can see, the CSI 300's PE, price to earnings, and its price to book ratios are trading at the low end of their historical ranges. And that fits our global theme of pivoting to value stocks. Now, indeed, China, as I say on the screen, is our preferred proxy for the emerging markets for a number of reasons. One, it's almost half of the MSCI Emerging Markets Index anyway. So if you're buying the MSCI Emerging Market Index, you're buying half China anyway. Two, it has one of the lowest inflation profiles in the emerging markets. And that's what you see in that chart on your left, which means there's less upward pressure on interest rates. Indeed, China has started cutting interest rates when others are raising rates or talking about raising rates. Three, it has one of the highest yield gaps in favor of stocks in the emerging markets. The only market, the only major market with a higher yield gap favoring stocks is Russia. But the problem with Russia is it is very much an oil and gas play, an oil and gas market. And if you wanted exposure to oil and gas, which I actually like, you can do that through the major US and European energy companies, the oil and gas companies there. Right. Now, continuing on with China. Now, as I said earlier, the People's Bank of China, the PBOC, recently cut its reserve requirement ratio, the RRR. And I think they will do more. Now, senior government officials have also been urging regional governments to fast forward infrastructure projects. And they've been urging banks to increase lending, all in efforts to boost the economy. So as you can see from the charts, aggregate financing and the financial conditions in China are both at the bottom of recent cycles. The Chinese government has been very sparing, some say stingy even, in the use of policy stimulus during the pandemic. Now, as a result of this, it has a lot of policy ammunition which it can now use. Now, I realize I'm a contrarian on this trade. So we have moved from China now to the US dollar. This is a chart showing the US dollar against inflation. Now, I realize I'm a contrarian on this trade. The mainstream view in the market is bullish, the US dollar on rising yields at the short end of the US Treasury curve. I'm bearish the US dollar. So I think what matters more is not the nominal 2-year US Treasury yield, but the real, the inflation adjusted yield, which is currently at -6% for the US, -6%. Now, that incidentally, if I can just go back again to why I think a bear market is not likely at this stage, it's because the real yields are -6. What else do you do, right? So now inflation has been running faster than increases in the 2-year US Treasury yield. And that's going to overhang the US dollar. And as you can see from the chart, the big upswings in US inflation through history have tended to coincide with a weaker dollar, not always, but more often than not. So inflation and the consequent rise in US Treasury yields have generally not resulted in a stronger dollar. History tells us that your odds are more likely to see a weaker dollar. So this goes back to my point about how inflation erodes currencies by diminishing the real inflation adjusted yield. And on this point, a couple of days ago, just yesterday, in fact, when we saw the 7% inflation for the US, 7% inflation for the US. And the US Treasury yields rose, yes, but the US dollar went down. Why? So some food for thought there. So I'm bearish on the US dollar. In summary, bearish on the US dollar, cautious on the US stock market. You've got to be very selective on US stocks. I don't think there's going to be a bear market, but you've got to be very careful there. I'd be more interested in European and Japanese equities in developed markets, more defensive, and I'm a bullish Chinese equities as a proxy play for emerging markets. And that brings me to the end of my presentation. I hand you back to Billy.
Thank you, Saidun, for a good presentation on the macro outlook. Just pass the time to Tim to present on the US market.
Hi, everybody. Thanks for that, Saidun. It was insightful on the macro level. So I'm just going to jump straight into it as well on the US. So let me just share my screen first. Okay, so I'm going to go through the disclaimer. So just to let you know, any stocks mentioned and et cetera, is not meant to be construed as financial advice, and just please do due diligence when you do invest. Okay, so as you know, Seiboon sort of alluded to, interest rates and treasuries are kind of making, you know, the headlines, right? I think we've kind of seen that in the recent sell-off of high growth. But to be honest, this has actually been something that has been selling off since probably December. So we're kind of into maybe like the 5th or 6th week of the sell-off here with some of that really high growth names. And actually the index itself obviously rose about 26%, the S&P 500 last year. And even now it's only about 5-6% off its highs, right? So it's still actually, it's still close to all-time highs from an index level. And that's mainly due to big tech, right? So we've kind of seen big tech hold up really well last year. And the expectation for them this year is obviously, I think, pretty high. But what's the actual story, right? I mean, everyone's scared of Jay Powell and what he's going to do and how much he's going to raise rates. But this is something that illustrates what Seiboon had actually mentioned earlier between the spread in terms of the earnings yield at the S&P 500 and the 10-year treasury. And you can kind of see that at the moment, this has probably ticked up a little bit with the 10-year about 1.7%. But the spread is, you know, is in no danger of sort of turning negative. So I think you've still got sort of buffer room there for investors, and even with the real yields sort of negative, in 10-year, in terms of the actual real treasury yield is, you know, deeply negative. And Tina, as we like to say, right, there is no alternative. I think that's a theme that's going to continue this year. You're looking at treasuries in terms of inflation adjusted returns looking at their worst since, you know, the 1980s, and you can kind of see with inflation being so high and the treasury, the 10-year treasury only being about 1.6, 1.7, it's going to have to rise substantially for that real inflation adjusted return to get close to break even or into positive territory. So for now, stocks do look to be on a path that, you know, should return positive over the longer term. And how far can they go in hiking, right? How far can the Fed actually hike given how much debt is being taken on globally? You can kind of see the left-hand side chart there. You know, global debt is now approaching sort of $300 trillion. As a percentage of GDP, it's, you know, off the charts, right? It's over 350%. So how much further can they raise rates without unsettling markets? And, you know, will Jay Powell then sort of ease up once he sees there's a correction coming or the correction goes too far? And we kind of need to remember that corrections are actually a very normal part of the stock market. I think obviously being in 2020 and then last year, even the positive returns kind of made everyone feel as though this just keeps going up forever. But the last correction was obviously in March 2020, a deep correction, but that was really quick, right? That was only about sort of 6 weeks. So if you kind of see the levels of the S&P 500 or the NASDAQ come off another sort of 10, 15%, I wouldn't be surprised in the first 6 months of this year, in the first half, leading up to the rate hikes. You can kind of see the right-hand side chart here. The periods around the rate hikes tend to be pretty choppy in terms of the market and what happens. But longer term, it's a good sign, right? I think right now the Fed is raising because inflation is hot, but the economy is still performing well and it's still doing well and it's still growing, right? So I think that's something that we should also keep in mind, is that the Fed is raising rates obviously because inflation is hot, but it doesn't get mentioned that the economy is also doing well and it's chugging along pretty nicely. Okay, so what's the theme of this year? I think this year is going to be really a theme of, you know, sort of size, scale, and finally, it's going to be sort of cash flow, right? Cash flow is going to be very important. So last year, you saw a lot of fundraising and you saw M&A kind of hit a new record high. Obviously, you had a bit of the SPAC craze in the early sort of Q1 of last year, and that raised up a lot of money. And you had a lot of companies come to market. But there's also been a lot of mergers in terms of companies, you know, coming together, buying each other out, or proposing synergies. And I think this is because there's the opportunity to raise money at low rates, knowing that the Fed was going to start raising either this year or next year, and it's obviously come a lot earlier. And so global M&A is really on. You've kind of seen that with even action in Singapore, for the example, the two Mapletree REITs merging. I think size is going to really matter. And so that is, I think, something that's going to be reflected in the stock market this year. We talk about international exposure. I think, Sabin touched on talking about Japan and Europe. I think if you do want to tap into international growth, there is definitely ample opportunity in the US. And we kind of forget that, because if you can see the left-hand side chart, S&P 500, there's actually faster growth for companies that have more than 50% of their revenue outside the US. I think that's obviously skewed a bit by companies like Apple and Chevron and some of the oil and gas giants, because they're so big. But it does tell you that you've got a global opportunity here when you do invest into companies in the S&P 500. So you're not really just confined to the US. You actually have a global opportunity set. And there are companies that are domiciled, obviously, somewhere elsewhere that have listings in the US. So do remember that the US is a truly, truly global market. And it doesn't mean that you need to, sort of go into esoteric markets and try and buy something that is going to tap into a specific market, because I think in the US, you're probably going to have that avenue to tap into if you want to. And buybacks are going to continue big time in 2022. You take a look at the left-hand side chart, you can kind of, I guess, interpret this in two ways. Either it's really scary that there's so much of the sort of S&P return over the past 10 years has been driven by buybacks, or you can kind of see it in a positive way. I think previously I used to judge buybacks as maybe not the best use of shareholders' money and company money, because there are so many examples of companies spending loads of money at all-time highs and being, and then just taking on debt and buying back shares at silly prices. And obviously you will have those, and they will get highlighted because that's just the way that the financial press works. But there's also a other side to it where there's, the 80 or 90% of companies that do buybacks in a responsible fashion. And to be honest, it's actually just another form of capital allocation and capital return rather than a dividend. And it's done mainly because it's preferable at the tax level, the corporate tax level in the US. So if you're seeing the multiple expansion over the past decade in the S&P, a lot of it has actually been driven by, price to earnings growth and earnings growth, but that's been driven a lot by buybacks. And that's not a terrible thing, because the companies that are carrying out the buybacks are huge. So you're talking about the likes of Apple, Microsoft, Google, basically all the tech guys, some of the big oil and gas giants as well. And these guys have a lot of cash to use up, right? So S&P 500 buybacks next year, or sorry, rather this year, it looks like it might set another record high, just because there's so much cash on balance sheets and they don't know what to do with it. So if they're going to do anything, they're going to try and return it to shareholders. And the best way, or the most capital efficient way in the US to return it to shareholders, is through buybacks. And you can kind of see how that flows into this next chart here with, money is going to talk, especially in this rising rate environment. If you look at the chart on the left, you can kind of see, obviously, Berkshire's had a massive cash hoard for ages, looking for, that massive, taking out the massive elephant gun, but it hasn't really worked out for Buffett and Berkshire so far. If you look at Apple, Alphabet, Microsoft, Amazon, all net cash, and just got just a lot of cash on their balance sheets, and they're going to put that to work, continuously, unless they see massive opportunities to acquire. And the thing is, with antitrust regulation now, they're not going to be making mega deals. They're not going to be pulling a $30-40 billion deal out there. And one of the best ways to drive earnings for them is to return cash to shareholders. So they'll probably start doing that. So I think this year it's going to be really important to watch for, in the market especially, positive operating and free cash flows. I think you've kind of seen in the high growth sector, a lot of the most punished names in the past sort of 6-7 weeks have been companies that are either loss making, don't have operating margins, or have they have more debt than cash. So the sort of cash rich names, the ones that are turning profitable, even some of the cloud stocks in the mid cap space that are turning profitable, they've actually held up okay. And it's been the ones that have really taken the brunt of the selling, have been the ones that are, obviously negative operating cash flow and free cash flow, and have more debt than cash. And that's going to impact balance sheets when they try and raise money in this sort of environment when rates are rising. Pricing power is going to be really important. Again, that's something that everyone talks about. Buffett's a big fan of buying businesses that have pricing power, because in this environment, that's going to be the true litmus test of the quality of the business, right? Can they raise prices, and can they keep sales growing, or can they keep their market share at the same level, or even take market share? And the competitive moat will be important, and obviously switching costs. So you want a company you want companies in your portfolio that are really going to have these characteristics for this year, because this is going to be a very volatile year in the S&P 500. And so, yeah, speaking of pricing power, the left-hand chart is something that was done up by UBS, pricing power score that they've kind of taken from the S&P 1500. And the right-hand side is a bit of a joke, just because I think the running joke is that if education was a company or was a sector, this would definitely have the most pricing power in the world, right? They've continually managed to raise prices for, I don't know, 30, 40 years. So but if you look at the actual sectors in the S&P, it's actually surprising what you'd say has pricing power, right? So stuff like consumer staples, comm services, which includes a lot of tech, information technology, which is obviously your cloud names, and you do consumer discretionary. So these guys like Apple, or say Microsoft or Google, what they are selling and what their clients are buying, can they switch? So if you're using Office 365, or if you're using Word or Excel, is there another alternative that you're going to use? Or if you're using Azure, or if you're using AWS, are you going to go work with another cloud vendor? The likelihood is probably not, because these guys have so much pricing power and so much strength in their particular niches that they can sort of implement that, right? Whereas things like energy and financials, you wouldn't be so. It's a bit surprising to say that, but obviously they do benefit, as Sabun touched on, in terms of the rising rate environment and the recovery. But in terms of pricing power, you want businesses that are solid, right, and they can continue to raise without harming the sales. And so the companies that you're going to find that in are in sort of the IT sectors, the comm services sector. So I think the sort of the strength of the business is really going to be tested this year, and that's going to be important for how portfolios hold up. And then finally, watch dividends. I think this is something important that maybe doesn't really get talked enough about. One reason why I think I'm turning in terms of how I think about buybacks is that actually buybacks are something that you can switch on and off. So companies that went into 2020 in the US having made buybacks or had buyback plans, and then suddenly was hit by the COVID-19 pandemic, they didn't have to cut dividends, because what they did is they just cut the buybacks down completely. Because if they are a dividend aristocrat who've been paying dividends for 30, 40, 50 years, they will defend that dividend, to come high water. So they will not cut that dividend. And you kind of seen that in 2020's numbers. That was full year 2020. This is from the Janus Henderson Dividend Index. That was the only region not to cut dividends, right? North America. So basically looking at that strength in dividend payments there. And just because I was talking about buybacks doesn't mean there are not great companies in the US that pay dividends as well. And so dividends, I think, is something that you kind of want to see continue to grow year after year. And they do tend to do that really well, a lot of these companies in the US. So that's something that I think we should keep in mind. And so a lot of companies, say in Europe or in the UK particularly, they took on a lot of debt to pay dividends. Their payout ratios, were very high. And then as soon as the COVID-19 pandemic hit, or there was a shock to the system, they had to cut, and they had to cut really, really sharply. And you can kind of see that in the numbers from 2020, especially for the UK, which was really ugly. So big tech, I think if you're thinking what's going to be reliable, I think what Sabun had touched on was, there is that rotation, which is definitely true. There is a rotation out of tech, out of growth into value. But if you're thinking about businesses that are just rock solid, that will just continue to perform, that will just continue to do what they say on the tin, the cash generation of these kinds of companies is just unparalleled, right? So for example, Microsoft, this is from the last 10 years. It's given shareholders positive returns in the past 10 years, and 9 out of those 9 years, they've been double digit, right? So last year it delivered 51% returns for shareholders. But if you're thinking about the amount of cash that it generates, it's close to sort of 20 20 billion free cash flow per quarter. You're looking at Apple, about 100 billion sort of annual run rate for free cash flow, right? So these guys generate so much cash and so much money that they're just not going to be challenged. And I think the only thing that's really going to maybe sort of topple them, is antitrust for some of these guys. And if you do see a correction in big tech, if you see a correction of 10-20%, it will definitely be a buying opportunity. So that's something to keep in mind, because at the moment, big tech has held up really, really well, and that they've held up the indices over the past sort of year, right? So I think if you think about if there's going to be a broader decline in the S&P in this first half, and big tech takes a beating, then I think these are companies that will definitely be popular choices for investors. And I thought I'd just give you a brief rundown of maybe of top picks across styles. I know there's, talk of big tech. I think, I'm a big fan of Microsoft, just what it has in terms of its positioning in cloud, its positioning in software, and then its positioning in gaming as well. So it has, 3 businesses that are doing really, really well. And it continues to pay a dividend as well as Apple. So we kind of forget that Microsoft and Apple, they're actually in the top sort of 10 dividend payers in terms of total amount in the world. And they continue to be up there every sort of year. Dividend growth, what Sabun had also talked about was infrastructure spending. I think this is something that really taps into owning real assets. And so Brookfield Infrastructure Partners, it actually owns real infrastructure assets like telecom towers, ports, toll roads, data centers, sort of midstream assets for oil and gas. But it doesn't actually have to, rely on the oil price of oil, or it doesn't dig all out of the ground. So it's not really involved in that part of the business, but it owns the infrastructure that carries out all these crucial day-to-day activities. It pays, a 3.3% yield. It's been growing it at about 10% per annum. And these guys are some of the best capital allocators in the world, right? Brookfield, which is Brookfield Asset Management. And these guys they kind of take maybe underperforming assets, buy them, really optimize how they're working, and then maybe they'll sell them for a premium at a later stage. But they have a lot of capital allocation, discipline, and they have a really, really strong balance sheet, and they have a lot of financial firepower to acquire if they want. If you're talking about growth and how I see value, I think, I see value in a bit of a different way. Of things have come down and they're trading at, maybe a price to sales that's a 5-6 year low, or it's pre-pandemic low. If you look at C is something that gives you access to this region. It's looking at, it's come down about 40%, 40% off its highs. And it's really, I think, continuing to perform, right? And you kind of see that being in Singapore or wherever, in Malaysia, in this region. It has a really compelling long-term growth story without the overhang of the politics that you might see in China. So that for me is something that I think is at the early stages in Southeast Asia. And they've been also performing really, really well in Latin America with Free Fire, and launching Shopee there as well. So I think if you're talking about something that's come off highs and is growth, and they've got 11 billion on the balance sheet in cash, so they've got a lot of money if they need to keep spending. And then banks, I've just touched on something that's a little bit less traditional, is SVB, which is Silicon Valley Bank Group. They have exposure to rising rates, but they're also the go-to funding partner for VC and tech in the West Coast, right, in the US. So with the rise of private capital markets, and a lot of money flowing into alternatives, I think these guys are the bankers of tech, of VC, of private equity, and they've been a great performer over the past sort of 5 years and 1 year, 5, 3, and 1 years, and they will probably continue to benefit from rising rates as well as demand for private assets. And with that, I will pass my slides back to Billy. I think I'm done with that. So thank you, everybody.
Thank you, Tim. Just a quick summary of basically what Tim has been saying. So correction is a very normal path to the stock market. If you see a 20 to 30% dip, that's probably a chance for you to get in for the long term. Buybacks will continue into 2022. Money will talk in 2022, the year of the survival of the fittest. Watch out for positive operating and free cash flow, net cash with little debt, pricing power, actual competitive modes, switching costs. And of course, thanks for the 4 stock picks that you've shared with us. Up next is Samuel, who will be talking about the Hong Kong and China market. Over to you, Samuel.
So very good evening to everybody. So I'm Samuel and I'll be presenting about the China and Hong Kong market update. So just a little disclaimer before I begin. Anything said here was only for education purpose only and does not constitute for any form of financial advice. So looking back at last year, we actually saw the Hang Seng dip 14%, and we saw that the China indices have dipped 5%. So in comparison to global indices, this has actually underperformed global indices, whereby you can see that last year itself, the S&P actually rose close to 27%. And so like what Sebun had been saying earlier, it may be a sign that markets could be bottoming for China and Hong Kong, and we may be looking at a potential reversal. So like what Sebun has been saying just now, it is actually looking at China to be a proxy towards the emerging markets and its bullish on China. So why then were markets badly wiped last year, and why is there a possible recovery story? So we can see that many events happened in Hong Kong and China markets last year, which was actually a first for many, and people were fearful of what to expect next. So we can see that last year itself, China was cracking down on the technology sector, and you can see that even in global relations, Sino and US tensions actually flared up last year, whereby you can see that US actually had blacklisted a number of Chinese companies, and then it has also stated that there were sanctions placed on certain Chinese companies as well. So all of this actually generated a lot of fear because people do not know what to expect next, and you can see that the clampdown has caused markets to be worried about what sector is going to clamp down next or what China is going to regulate next. So this actually shattered investors' confidence. However, we can also see that in terms of regulatory fears, it's often priced in by markets as well, and priced in a negative way. And every time, like example, you can see that when regulatory risk has been placed into markets, sell-off occurs. But that being said, we have to look towards this year and to see whether regulatory risk will still be a concern and what exactly in regulatory risk we are looking for. So we can see that the key events to look out for in China markets this year, actually I break it down to three main factors. The first is an internal factor, then we look at the external factors, and lastly is the global events. So focusing on the internal factors first, we still think that policy tone is very important. So when we are looking at policy tone, we must always go back to the China's 5-year plan, because unlike other countries, China tend to plan ahead, and China always have this 5-year plan which they will stick closely towards. And you can see that as a matter of fact, they are actually looking towards some of the key things they're looking towards is foreign participation and domestic circulation. And all of this is because they would like to internationalize the Chinese markets. And we can see that there are many opportunities about opening up as well as the expansion of domestic markets. And so even though we look at regulation, regulatory controls as something that is bad for markets and markets remain fearful of that, it's actually in the long run helpful in one way or another to ensure that Chinese markets adhere to certain standards, and then because of that it will attract more foreign interest going forward. So that being said, if we look at the latest China's Central Economic Work Conference, which was held last year in the November period, they actually talk about certain factors which may be interesting because we will be looking at this year and whether it will come true, and this will actually result in more market sentiment in terms of the growth story of China itself.
Samuel, sorry, I think your mic is a bit muffled. Do you want to just fix it first? Yeah, sorry for the hiccup, guys.
Sorry, is it better?
Yep, now it's way better. Thanks, man.
Oh, sorry about it. So, okay, so like example I was saying, for the key takeaways in the recent work conference, we'll be actually looking that China is actually, like what Sebun mentioned just now, easing monetary policies, unlike other nations who are tightening monetary policy. So it shows that they are still in a growth mode, and it will present more upside potential for Chinese markets. So in the key takeaways for this conference, China was actually talking about fair competition policies, anti-monopoly, which actually has been in action since last year as well. And so with most of the regulatory policies actually placed last year, we may see is more of a stabilization this year and not so much about literally more policies that will actually derail markets from there. But that being said, we have to look about, in terms of anti-monopoly, what they are actually focusing on. So they are actually focusing more on the IP rights, about the data protection. So you can see it's actually a lot of supply side reforms to actually make it more regulated in terms of the industry and make it more less easily for people to manipulate. So in the long run, it's actually beneficial for China's growth story as a whole. So you can see that aside from common prosperity, which they have emphasized again and again, they are actually, it's good for China because it actually focus is being placed on household income and employment, and it's going to grow, create China's growth in terms of the economic growth going forward. They are also controlling the property sector, and we have also seen that they have been emphasizing on housing is for living and not speculation. Although there has been a lot of fears with regards to the liquidity crunch ongoing in the property sector, we have to take note that China is also trying to prevent the property sector from collapsing, and it's easing certain measures in one way or another. Like recently, earlier this year, we can see that they have eased the M&A measures to ensure that state-owned companies can actually help take over distressed assets to ensure that the sector remains stable. So all of these are things that we are looking towards, and that it may be more of a recovery story this year for Chinese markets. Also, we have to take note that the Anti-Monopoly Bureau has been elevated in terms of status, and although markets are fearful about greater regulatory, this is actually seen as a long-term growth story because there need to be some form of regulation before there can be strong growth going forth. And so we expect the regulatory crackdowns is going to continue. But that being said, if you look at the measures in place by the regulatory crackdowns since the start of the year, it has been milder than what happened last year itself. So like what our analysts have been stating, that like example, the fines that it placed towards Tencent or Alibaba this year itself were merely just fines and less severe as compared to some of the things whereby there was stop operations, etc. Or like example, the education sector last year, whereby the total change of rules from a profit organization to a non-profit organization. So we can see that the punishment placed is actually much milder. So even though they are actually still focusing on antitrust regulations, I think that the key importance people have to take note of will be on data protection. Because what happens is that the data protection has been emphasized a lot of times, and they have yet to actually fully clamp down on the data protection aside from listing rules. So because of that, we may want to take note of this segment, and for companies that have more data and are more data sensitive, this will be some of the things that markets will be looking towards. And because China has now emphasizing a lot on national security risks, so that's why this resulted in some of the Chinese ADRs being affected, etc. So aside from internal policies, external policies will also be very, very important because we are talking towards the geopolitical climate. So the geopolitical climate works both ways. There can be positivity and negativity, and we have to see what actually develops from there. So if we're looking at trade deals, we can see that China since this year have actually signed the RCEP, and this is going to benefit China's exports. So even as it started this year, REIT is going to cover 15 economies, and of which 10 have started, and the remainder will join subsequently. So out of these 15 nations, they will account for 30% of global GDP. And the total tariff saved for China at the moment is around 4.4 billion. However, it will actually rise to over 10 billion US dollars when all are joined. So this, when all the nations have actually joined, and this pact is fully intact. So these nations are going to join subsequently, and we can see that Korea is going to join in March. So all of these are going to benefit China positively, because what happens is that imagine this $10 billion savings that China is getting is going to actually increase its exports, as well as going to overall improve its economy as a whole. So this shows the potential that China can still grow, and if it secures more trade deals going forth, this will benefit Chinese economy. However, we can see that there is still negativity inside as well, and people will be looking towards these uncertainties to see how it develops. The first thing I think that everybody will remain very strongly concerned about is Sino-US relations. as mentioned, it was dominating last year in terms of the what was happening there, and people were looking towards how Sino-US relations develop and whether there will be more sanctions placed towards China. So I think that this year itself, people will be focusing towards the phase one trade deal. And I think that the phase one trade deal serves as one of the key factors in determining relations, because what happens is that it will be one of the report cards that China and US will be looking towards. China has yet to meet the requirements because it has only purchased about 59% of what it promised as at December last year. So US have been emphasizing during the talks last year that they may want to enforce actions against China if it fails to meet the requirements. And I think that this is what people will be looking towards, whether actions will be enforced and whether there will be more tariffs placed on China by US. If there's nothing, then naturally, or if, like example, they come to a consensus or something positive developed from there, this will be a positive event. But of course, the reverse is true if more tariffs are being placed on China. And we can see that US Congress is not making life easy for China as well. They are still aimed at imposing more sanctions towards China and in talks to add like more technology products onto this entity list. What is the entity list, people may inquire? It's actually, if like example, if Chinese companies are placed on this entity list, if US companies want to do business with these Chinese companies, they will have to seek appropriate approval from the government authorities before they can do so. So this actually increases the barrier of entry for them to do business with China. Also, it's also in talks to add more companies to the US blacklist. So we have to closely monitor this situation to see if it comes true. Lastly, we can see that in terms of US listed Chinese companies, it's still facing a lot of uncertainty because not only did the SEC hint towards greater scrutiny for these companies, it's also facing a two-way squeeze whereby Chinese authorities have also made it harder for Chinese companies to list in the US due to the data control, etc. So I think we have to watch this development closely. And lastly, for global events, I think it's very important to watch about the COVID developments, whereby we can see that right now China is facing certain levels of lockdown because of its zero COVID tolerance policies, and that is trying to control the COVID spread of Omicron. So this year will be the third year living with COVID, and I think that the key risk will be the effectiveness of the vaccines and medications and whether globally we can open up. Because I think if opening up is on the cards, then naturally you can see that China's economy and the global economy will benefit as a whole. So COVID-driven inflation and related economic weakness will remain key. And we can see that inflation numbers in China have corrected slightly because after the government intervention, etc. And we can see that China's official GDP, official manufacturing numbers are also going up because of support from the various authorities. So I think that going forward, we have to see whether this will remain, and if, like example, like stated, more trade deals are on the cards or with greater exports, naturally you can see China will benefit as a whole economically. And so, talking so much about China economy and the Hong Kong markets, I think that we have to go back down to what are the sectors that we could look at. And so our analysts at CGS-CIMB have recommended certain sectors to look at for the first quarter this year, and they feel that there may be more upside potential for these three sectors, namely the telecommunication sector, the consumer staple sector, and lastly, the technology headset sector. So for the telecommunication sector, they feel that it's a potential beneficiary of the 14th five-year plan, as I explained just now, because a lot of investment for related infrastructure is on the plans, and it will actually significantly increase. We can also see that China has been enforcing a lot on 5G development, and there's still huge potential in this sector. The metaverse is also expected to drive the 5G development in the two consumer growth segment, and because of that, related companies will see potential upside. So some of the companies that our analysts are bullish on is ZTE, as well as China Tower. And if you look at ZTE, technical-wise, it also shows a certain recovery story based on our technical analysis as well. And the next segment is the consumer staple segment. So the consumer staple segment, our analyst feels that there's less margin pressure expected for the upcoming year, solely because a lot of these companies are expected to do price hikes, And because of that, it will actually significantly improve its profit margin. Also, there is no change in the premiumization trend, whereby we can see that now consumers are actually looking more towards the premium products, which generate more profit revenue for these companies as well. So when consumers, even though it's COVID, etc., they feel that they would like the more premium brands. And because of that, it's actually driving up the revenue stream for consumer staple in terms of the industry itself. So because of that, our analysts are looking towards companies like China Resource Beer, as well as Ely, which actually produces milk in China. So for China Resource Beer, our technical analysts recently actually come up with a positive technical call for it as well. So it shows that there may be more upside potential for this counter. Lastly, on the technology and headset sector, we can see that it's going to benefit from advancements in the camera technology. So what happens is that we can see that the camera technology is becoming more and more advanced, and the displays are going to get more innovative. So there's also huge potential in the artificial intelligence side of things, whereby these camera modules will be used for electric vehicles, as well as the upcoming automobile industry as well. And because of that, a lot of these manufacturers may see strong growth, and our analysts are bullish on Sunny Optical as well as Xiaomi. With that, I'll pass the time back to Billy. Billy, please. Thank you.
Thank you, Samuel. Your presentation helps to elevate some of the fear that I have over China and Hong Kong. Anyway, just a brief summary on what Samuel has been talking. So basically, the crackdowns that we saw last year is basically really good for Chinese in the long term because of the focus on fair competition policies such as anti-monopoly, strengthening the IP rights, the common prosperity theme as well, household income and employment. Of course, the three sectors that Samuel emphasized on, telco, consumer staples, and tech. So without wasting much time, let me just pass the time to Sesiang. Sesiang, over to you on Malaysia.
All right, thank you, Billy. Good evening, everybody. 1 second while I show out the slides. Okay, so yeah, for those who don't know me, I'm Sesiang. I'm the head of retail research in Malaysia. And today I'm just going to talk about what is in store for Malaysia for 2022. So I think I'm going to be the only odd one out today. I'm the only one who is going to talk about the strategy based on technical analysis. And without further ado, just quickly run through the slide. Okay, this is just the standard disclaimer. Okay, today these are the key discussion points. I'm going to talk about what cycles are and where are we in cycles for KLCI. Quickly run the sector, the good and the bad based on, and then some topics for the 2022. Cycles can be seen everywhere. I mean, cycles. It's also, you can also find Newton's third law of motion here in cycles, but for markets, usually what goes up must come down. So it may not be in the same magnitude or length, but yeah, it doesn't go up in one straight line, it doesn't go down in one straight line. So cycles also, it's can be found everywhere in nature. There's the sunset, sunrise cycle, then you get a water cycle, 4 seasons in a year. These are more of natural cycles. You can also be man-made cycles where you can find those in music, and every 4 years we have the World Cup or Olympics, as well as the cap. Yep.
I think your mic is also a bit soft, and probably your line is also a bit laggy, so your mic is also a bit soft.
I see. Yeah. It was okay all this while until my turn. I'm not sure why, but yeah. So anyway, I hope you can hear me. Yeah. So cycles can also be found man-made, so you get the calendars as well. So what is good, or what is the pros of the cycles is that they are repetitive and they are predictable. So you can also prepare for the good and bad times based on cycles. So everybody here in Malaysia talks about a 10-year cycle. So since its inception, there is a 10.5-year cycle or 126-month cycle. So if you look at the bottom end of the chart, you can see a dark black semicircle, and that is the 10.5-year or 126-month cycle. So at the end of every cycle, very likely there is a sell-off, and it does fall to it. The KLCI does fall to its the red line, which is the 200-month exponential moving average, and that usually tend to signal the end of the cycle and the start of it. The new cycle is very likely underway. There was an exception here in 1998. It extended a little bit to about 7 months or so before starting its rise. So in this cycle, in the 10.5-year cycle, you also find that at every cycle, the KLCI do hit a new all-time high. So in the first cycle, you can see that it hit 540, 1332, 1524, 1896, and so on. So yeah. So potentially with now, the last cycle ended in June of 2019, but you can see that there was no test of the red exponential moving average. So that's why in our strategy report, we did mention that the cycle was slightly, and we saw that test when COVID hit. So the market did fall and fell below the moving average before rebounding quickly back above those lines. So what is good about this cycle is that cycle actually tells you put you in the right direction, but it's not like race. So it doesn't give you the right timing or the right road to take, which stock to buy and so on, but at least it gives you the right direction to prepare, in which you should prepare your investment cycle if you have a 5 to 7 year investment horizon. So we zoom in further, so you can clearly see this 126-month cycle that ended in June of 2019. But you can see that prices that rebound from the COVID low has actually come up to some resistance, and that you see a double top pattern that formed from 2012 to 2019, and hit the neckline of about 1550 to about 1620. That has actually what was previously supporting. So the index is actually a little bit of difficulty to push back above this 1550, 1620 levels, some sort of consolidation pattern for most of 2021. There is a, sorry, I think the internet is down again.
So maybe why don't you try turning off your video and see? Then it won't take so much bandwidth. I mean, I'm not sure, but you know.
Yeah, I think it should be okay, I guess. Yeah.
Okay.
So anyway, yeah. So I just continue. Anyway, you can also see that if you look at the bottom end of the chart, there is a red semicircle and a green semicircle. The red one is the 42-month cycle, and the green one is the 21-month cycle. And both of the cycles seems to be on a downtrend for 2022. So I think for 2022, there is very likely to be some downward pressure for the Malaysian market at least. You may not see a crash, but potentially it will be under some selling pressure. So I think based on cycles, potentially 2022 may turn out to be something like 2021. So right now, I think in terms of support and resistance, the 200-month exponential moving average is at 1461, and most important level to look out for is 1620. And if the index can actually push above 1620, I think very likely it's all clear for the bull market to see a push to a new high for the months and years to come. So again, here zooming in quickly here, you can see a potential sideways pattern that has formed since June of 2020. Market has just gone actually traded sideways between 1450 to about 1620 with a slight push above that 1620 levels in the December of 2020 , but overall it's been just gone sideways. So I think this is very much a base building period for the index and also for the Malaysian market as well. So overall, I think the market should remain in some sort of a consolidation for most of 2022. Okay, so the key support here it's at 1450. So if that breaks, then potentially this head and shoulder pattern could potentially take the index down to about the 1,300 levels. But 1,330 to about 1,370, that's some key strong support for the index on the monthly chart. So potentially, those are the levels to look out for if there is a sell-off for the index. On the again here, the 200-week exponential moving average is at about close to the 1,600 levels. So the key level here to watch out on the upside, if it breaks, then potentially then we could see a big the start of a bigger move for the Malaysian market. This is just the zoom chart of the daily chart. Again, here there's not much action in the Malaysian market over the past year. So it's just been trading sideways. Lately, it's just been within 1,005 to 1,006. So overall, the 10.5-year cycle suggests that there is a new big upswing that is underway. And we believe that this rising tide or the wave will lift all boats, big and small stocks. So if you're a long-term investor and which have an investment horizon of about 5 to 7 years on, I think any weakness that you see in the coming year would provide a good time to actually accumulate good stocks. If you're a more short-term trader, I think for now it's better to keep exposure low, or you can actually trade when there is profits. You could look to keep lock in profits as quick as possible for the time being. So in terms of sector, last year sector-wise, technology, industrial, and transport were the strongest sector. Financials came in fourth, but the worst sectors or the worst performing sectors were construction, energy, healthcare, and the FBMAs, which is the mass tech counters. So in terms of momentum, we still like the tech index, the tech sector. You can see the tech sector has actually hit its 21-year high late last year, 2021, and it actually broken out to key levels, which is above the 70-point levels. So right now, it has pulled back a bit for this week. I think there is also a shift similar to what Siwon mentioned earlier. There is a shift over to growth stock here in Malaysia as well. So we zoom in, the index has actually dropped to its 50-week exponential moving average, which is close to the 87 levels this week. So I think potentially you could see a little bit more weakness here before it actually pushes on higher based on momentum. So strong support can be seen close to the 70 points level that I mentioned here. So as this pullback is roughly about 10 to 20% down. So again, if there is a correction over in the US, the tech sector, and it does drop to the 70-point levels, then I think the tech sector would be a good level to get into the technology sector here in Malaysia. As for industrial production, this was also the outperformer for 2020 and 2021. It is close to hitting its all-time high, but it's now facing some strong resistance right now. So I think similar to the tech sector, I think there is going to be some weakness, at least in the near term. Again, a pullback to its 200-week moving average would be a good level to get in for the industrial production sector. We also like the transport sector. This one here, the uptrend seems to be firmly intact right now. It is trading close to its all-time high. I think very likely the transport sector or the logistics sector will continue to outperform here in 2022. So what we like most, at least in terms of sector, is going to be the financial side. I think this week itself, there was a strong move into some financial stocks here in Malaysia. It has broken out of its consolidation triangle that lasted about a year or so. And I think this sector has got probably room to actually continue to push on higher for at least the first half of 2020. In terms of sector, the consumer sector, actually one of the weaker sectors. You can clearly see the lower lows and low highs indicate that the short-term trend from the 2021 highs is still on a downtrend. It is also trading below its 200-week exponential moving average, which is the red line. So it does suggest that the trend is still down, or at least it's still still in some sort of a consolidation for the consumer side. But at least right now it's partially holding above its what was previously resistant. Is now acting as support. So as long as it doesn't drop too far beyond the 550 levels here, I think it should actually continue to form a base, at least in the first half of 2021. So if a base is formed, then it allows consumer sector to actually push on higher to continue the trend that began in 2020 with a firmer footing. So if you're probably looking for more consolidation first before a breakout move or breakout pattern that takes place here for on the consumer side. Property itself, although the rebound was pretty strong in 2020, but 2021 is just pretty much in a sideways trend. It was pretty volatile here for the property sector, but nonetheless, it is in consolidation and is still trading below its 200-week exponential moving average. So momentum-wise, we don't see any strong momentum going into the property sector at this point in time. Again here, if it holds its key Fibonacci support at about 586 to 656 levels, then again, we need a base for it to actually launch higher, maybe sometime in 2023. Construction is also another, was one of the laggards in 2021, and it's item-wise going into 2022 is still weak. What is a slight positive here for the KL construction side is that it is holding it within the lower end of its 150 to 190 trading band. So in terms of trading, at least in the first half of this year, there is some potential here for construction to actually outperform, at least in the near term. But so finally, on the healthcare side, it was a weak year for the healthcare stocks, especially the glove counters. The healthcare side has been consolidation for about a year and a half. And I think potentially there are no signs of a reversal just yet, but it is holding at its 200-week exponential moving average, which is the red line. So we do see further upside or further healthcare sector, then potentially this could be one of the sectors to look out for in terms of a mean reversion rebound for the healthcare side going into the first half of this year. Quickly, just topics. We like Telecom Malaysia. Telecom Malaysia is one of our top Malaysian telco pick, as well as one of the top ESG picks here in Malaysia. So in terms of charting wise, it hit its all-time high in 2021 before consolidating for most of the year. And I think it is coming to a level of support close to the 525 to 530 levels for Telecom Malaysia. As long as it doesn't, you can clearly see that it has formed higher high, higher low since 2018. That actually bodes well for the longer term, suggesting that the uptrend or the current move since the all-time high of 666 is only just a minor correction before the longer term uptrend continues. So as long as it continues to stay above its the $5 levels and max, I think Telecom Malaysia has a potential to actually outperform in 2022. We also like Tongguan Industry. It is one of the largest stretch film producer in the world. If you look on its chart, there was a major breakout, a 5-year breakout 5-year consolidation from 2016 to 2020, and we saw the breakout in 2020. So what was previously resistant is support when prices pulled back from the 330 all-time high. It is now higher lows since the pullback in 2021. So right now, it suggests that the uptrend is very likely to continue on for most of 2022, but the key support here is at 239. Longer term, as long as it doesn't fall too far beyond $2, I think this stock has got potential even for longer term beyond 2022. We also like Wellcore. One of the plus side for Wellcore is that it is one of the largest industrial hose manufacturer here in Malaysia. What is also good is that it has been paying solid dividends of about 5 to about 6%. It's forecasted to pay dividends of roughly about 5 to 6% for 2022 to 2024. So in terms of chart-wise, we saw a major breakout of its 5-year consolidation. That breakout very likely suggests that 5-year consolidation is over, and the long-term uptrend for Wellcore is now very likely underway. So it is trading very close to its all-time high of 145, and I think the stock has got potential to actually push on beyond the 145 high in the months to come. We also like Gamuda. It has been a laggard. It is a construction stock, although construction, the momentum for construction sector is weak, but you can see here for the stock itself, it is holding just above its multi-year support trend line from the 1997 to 1998 lows. So if you zoom in, it has been consolidating for the past 5 years, and it's trading at the lower end of this sort of like a triangle pattern that we see. Here, your stop can be placed below 260 or below your 236. But overall, in terms of risk to reward, I think this one has got some room for it to actually push higher here in 2022 for Gamuda. So just quickly, in terms of topics on the fundamental side, I won't have time to go through all of this. The list, I'll just quickly leave it here for you to take a screenshot. This is the big cap list of our ad calls for CGS-CIMB here in Malaysia. And this is the small cap picks for CGS-CIMB in Malaysia. These are the top 3 picks that we like. Hong Leong Bank for its for the potential to take advantage of the potential increase in OPR in the second half of 2022, and as well as its stronger contribution from the Bank of Ching. For growth, we also like Inari Amatron. It is one of the tech stocks that we like. I think if any weakness that we see in terms of pullback in the tech sector, I think this would allow investors to actually get in at a cheaper price for one of the better tech counters here in Malaysia. We also like QL for again, this is very much on the consumer recovery play. This is one of our top 3 picks here for Malaysia. So I think that is all I have to share for today, and I'll pass it back to Billy then. Thank you.
Thank you, Se Xiang, for the presentation on the technical, especially on the technical side. It's interesting to see how one look at the market on a technical basis. 10-year cycle is something that really excites me. Of course, I'm sure that some of you probably take out your camera when Se Xiang shows off the top picks in Malaysia. Huh? All right, without wasting much time, let me just pass to our last speaker today. Mani, over to you to talk about the Singapore REITs market.
Thank you, Billy. Good evening, everyone. Today we'll be just talking about our views on the Singapore REITs sector. So let me just share my screen. Sorry.
Is it okay on your end, Mani?
Sorry, my screen has blacked out. Just give me a couple of seconds.
Okay, no worries. Are you using dual screen, Mani?
No, let me stop my video. Maybe that will.
Yeah, your video is frozen, so. Are you still there, Mani?
Yes, I am. So sorry about this.
How about maybe we can ask Crystal to share the screen instead? I think she would have your slide, right?
Yes.
I can do the sharing.
I can't see my screen, unfortunately. Perhaps, yeah. Why don't you I'll stop sharing, and yes, I'm back. So Crystal, if you don't mind, can help me share screen?
Yeah, I'm sharing
Thank you
your
so
screen,
much.
your slides ready. Are you able to see it?
Yes, yes. Thank you so much. And apologies everyone for this technical hiccup. So without further delay, let me just start on the presentation. Next, please. Next page, please. Thank you. Yeah, so this is what has been happening to the REIT sector. So we saw that, since the beginning of the year, it was a little bit of an inauspicious start for the SREIT sector. The index was down about 3% compared to a 3.3% rise in the broader market. And as Sebun was saying, all this news on higher and sooner than expected interest rate hikes and the continued inflationary pressure has actually dragged on the performance of the SREITs. And also there's increasing caution over the emergence of Omicron variant. But nonetheless, SREITs continued to be quite active. At the end of December, we saw the announcement on the proposed merger of MCT and Magic. The REITs continue to acquire assets. KDC REIT made an announcement on the acquisition of a data center in UK, while two other REITs, Mint and ESR REIT, also announced asset divestments. And lastly, SPH REIT just announced their first quarter 2022 business update, kickstarting off the REIT's reporting season. Next page, please. Okay, so what has changed since the end of last year? And basically, it is the signaling by the Feds that it will double the pace of its tapering activities and flagging that there will be 3 rate hikes in 2022, while inflation still remains elevated. In this table on this page, we share the projections of our CIMB economists and also our Treasury and Markets Research team. So basically, CGS-CIMB economists forecast for Singapore inflation to reach 2.3% in 2022, higher than the average of 1.8% in 2021. And the expectation is that this inflationary pressure should be more apparently felt in the first half of the year. Meanwhile, on the 9th of December, our Treasury and Markets team also announced their navigator, which gives us a projection of their expectation on the bond yields across the ASEAN countries and also for US from the first quarter of 2022 to the first quarter of 2023. And you can see from the table below that for Singapore, the expectation is that the 10-year government bond yield could rise by up to 65 basis points, and in US is expected to go up by about 40 basis points. So what would happen is that if historically we track the REIT index versus interest rate and yield spread performance, during this period of rising interest rates, at the beginning of rising interest rate cycle, the REITs tend to underperform. But I think 6 to 8 months after the interest rate cycle has started to pick up, we do see that the REITs tend to catch up. And again, it goes back to what Sabun was saying, that inflation, it is not a totally bad thing, because we do see inflation as having a positive effect on real estate values. So we think that with the signaling of inflation and more certainty in terms of economic growth, landlords would be able to have better pricing power as far as rents and capital values are concerned. So we think that the market would need time to adjust. The REITs market would need time to adjust. So we think that near term, the market would be choppy. But in the medium term, we do think that the REITs market will continue to perform well. So what would investors focus on in the near term? We think that at this turn in the interest rate cycle, investors would focus on the potential impact of rising interest rates on SREIT valuations and also on earnings. But at the same time, we'll also seek opportunities to look for growth drivers to offset the impact of higher rates. Next page, please. So we look at the first point on valuations. So in our universe coverage of SREITs, we estimate that the dividend yield growth for SREITs will be about 5% growth in 2022, followed by a 3% growth in 2023. So it's still going to be positively growing as far as dividends are concerned because of improving earnings. So if we look at that from a basis point of view, this 2 years of growth would translate to about a 40 to 50 basis point rise in dividend yields over the next 2 years. So to put that into context, SREITs are currently trading at about 4.9% financial year 22 dividend yield, representing about 310 basis point spread over the 10-year government bond yield. So taking into account our economist projections for a 65 basis point rise in the 10-year bond yield in Singapore, and also factoring in the projected growth in dividend yields, we think that SREITs may continue to retrace slightly to offset the impact of the faster rate hike. Essentially, we think that overall, the REITs market may come off by 5 to 10%. We have already seen a 3% decline, so a little bit more to offset the impact of this projected rise in the bond yields. We also note that our projections have not factored in any future acquisitions. So if the REITs do acquire accretively, dividends will continue to grow, and this will also offset the quantum or the magnitude of the retracement on better earnings. Next page, please. Okay, the next thing that we look at is the effect of rising interest rates on the REITs earnings. Currently, if you look at the REITs sector, the debt to asset ratio of the sector stands at about 36%. The good news is that as REITs have hedged an average of about 76% of their total debt into fixed rates. So this will give some protection against the rising rate environment. But given that this interest rate cycle, if this interest rate cycle uptrend is sustained, I think overall it could lead to a higher average funding cost in the longer term. So what could be the potential impact? When we did a sensitivity, we note that a 0.1% rise in average funding costs could erode DPUs or dividend yields by about 0.1 to 2%. So it's still a relatively muted impact at this point in time. Next page, please. Okay, so what what should one do under the current environment and in view of the rising rate outlook? As our colleague Se Xiang says, things do not go up in a straight line, nor do they come down in a straight line. So we think that the SREIT's performance could be choppy in the near term as the market adjusts to the rising interest rate outlook. We do see a little bit more downside, but it probably will not go down in a straight line. And I think the important things to note is on the news flow about the outlook on inflation, particularly in the US. We do see that any market weakness are buying opportunities to position for the SREITs in the medium term. I think one of the stocks that we continue to like in the near term is KDC REIT. This stock has come down by about 16% last year, on top of another 6% down so far year to date. So, at a 4.5% yield, it's not very expensive, and the earnings are pretty resilient. So we think that, potentially people could look at this if there's further weakness in the stock. The other strategy that we are looking at as far as REITs are concerned is that with the narrowing of yield spreads due to the rising 10-year government bond yields, we think that investors should adopt a strategy on looking for REITs with good growth outlook that can grow their dividends, grow their earnings, and this will help them maintain the yield spread to the government bond yields or offset some of the narrowing yield effect. So how do we look for REITs with good or good growth outlook? Firstly, we look for SREITs with strong dividend yield growth outlook over the next 2 years. And if you look at the right-hand side table, we list the stocks in terms of the FY22 dividend yield growth potential, and also the cumulative growth for FY22 and FY23. And what we note is that the top 3 stocks, as far as FY22 growth potential is concerned, would be stocks like CDL Hospitality Trust, Ascott Residence Trust, and also Land Lease REIT. And this is because I think hospitality REITs earnings are coming off a low base as well. For those that have the strongest cumulative growth over the next 2 years, will be really the hospitality REITs coming off a low base, and also Land Lease REIT. So these are the stocks that we could potentially watch out for if the market continues to drift down for opportunities. The other strategy that we have on the SREITs is that we look for stocks that can actually drive growth through acquisitions or asset enhancement initiatives. As Tim Phillips was saying just now, size does matter. So you see that a lot of the REITs have actually merged to gain size and scale to compete for assets on the global arena. So we think that in addition to size and scale, those REITs that have strong sponsor pipeline, things like Capital Integrated Commercial Trust, Fraser's Logistics Commercial Trust, Mapletree Industrial Trust, these have also sponsor pipelines of assets that they could potentially acquire, and accretive acquisitions would also build on earnings and build on yield as well. So this will also add to the growth outlook of the REITs in the medium term. Okay, next page, please. Okay. This is my last slide. This basically gives you a comparison table of where the projected yields of the SREITs that we cover. Again, we look at the hospitality REITs are yielding about 4 to about a high 4 percentage point range of dividend yields. Within the retail sector, like CapitaLand Integrated Commercial Trust is yielding about 5.7% based on our estimates. and Mapletree Industrial is yielding about 4.5% based on our estimates as well. So in all, I think the look for growth, that would be what we are advocating investors to help offset some of the potential yield compression coming in from the higher bond yields. That wraps up my presentation. Back to you, Billy.
Thank you, Mani, for your presentation. So basically, a choppy near term for the SREITs, but look for those REITs with good growth outlook. Size does matter. I like that. So, all right, let's just move on to Q&A without wasting much time. Can I ask the speakers to turn on their video? Yeah, so that everyone can see them. Great. Okay, so we have the first question, basically on the rate hike. So I think this would probably best be answered by Sebun, but Tim could just chip in if he wanted to, right? Basically, is the 4 rate hikes expected? I think that's probably one of the worst case. Is that enough to bring the inflation down to the level that Fed is expecting for 2022?
No. There is something called the Taylor rule sort of model, which looks at where the interest rate should be given any set of inflation and employment. And currently, the Taylor rule is suggesting the appropriate rate for the Fed funds target rate would be somewhere between 5 and 6%.
Oh,
5 and 6%.
Okay.
And when you look at the unemployment in the US, it's hit 3.9. 3.9 was reported about a week ago. Now 3.9 is full normalization of the unemployment rate in the US back to before the pandemic. Now, and there's something else called the NIRU, the non-accelerating inflation rate of unemployment. That in the US should be much higher than that. So currently we are looking at US unemployment so low that it is resulting in wages going up, and the data is there. The average hourly earnings are going up. So the risk now is a bit feeding back into the inflation loop. And then something else that we've got to think about is that although Omicron is less deadly, and the theory and sounds plausible, is that it could then become an endemic and life returns to normal eventually. Right now, it is causing chaos to the supply chain everywhere. Anecdotal, I'm sure you already know it. I've been out there trying to get stuff for myself in Australian supermarkets, and the logistics hubs have frozen up because people are just getting sick left, right, and center, right? Because it's so transmissible. So I don't expect that to lift so quickly. And bear in mind that China is the heart of the global supply chain, and China is still on COVID-0, right? They are still trying to suppress, as Samuel said, this is an unknown for China, right? So, and they are suppressing this ahead of the Winter Olympics. Can they continue to suppress it after the Winter Olympics? I don't know. I have my serious reservations, particularly given the transmissibility of Omicron and population of 1,400 million people, seriously, right? So my guess is if eventually it's going to get to China, and when it gets to China, the supply chain is going to be broken as you've never seen before. So that's going to feed back. So I don't think 4 rate hikes is going to solve the problem. I do not see inflation moderating in the first half of this year. I don't see it moderating in first half of this year. With a lot of luck, you might see it moderating in the second half of this year. And what could go terribly wrong is China. So that's a long answer. The short answer is no.
Sorry, Sabin, so what you're expecting how many rate hikes for this year? Your base case?
Well, I'm going with the 4, right?
Okay.
I'm going with the 4, which is increasingly being priced in now. I haven't checked it in the last 24 hours. I suspect it's pretty much priced in now. So that's okay. It's already been priced in. But so I'm not looking at this in terms of it being terrible for the stock market, right? Because I look at it very differently. I look at it in terms of the real rates and the real yields, right? Now, you've got 7% inflation, yes? Yeah. Now, what's the 10-year US Treasury yield doing now? 1.7?
Yeah.
Okay. So we're deeply, deeply negative real yield. So you're not going to get any joy putting your money into a bond. And with, right, let's say 4 rate hikes. Let's price it in now. Let's say we have a Fed funds rate of 100 basis points. You've got 700 basis points of inflation. You've got negative 600 basis points real rates. You know, it makes it difficult for a sustained bear market. Let me repeat, sustained bear market. And as Sesiang was saying, markets do not move in straight lines. You could see corrections, you could see sizable corrections, you could see a shock even, but by the end of the year, I don't think it can be sustained if you've got deep negative real rates and deep negative real yields. So all I'm really looking at is where we can get better performance. So if you're looking at minus 600 basis points of real rates, even after 4 rate hikes, right? And you think the US market is rather expensive, you go looking outside of the US for other opportunities. And that's where I think we're starting to see, back to what we were talking about China and what what Samuel was saying about China. What Samuel was saying about China. There has been a pronounced return of interest back into China. The banks that were saying China was totally uninvestable only, was it 3 months ago, are now turning back into China again.
Okay. Tim, you want to add anything?
Yeah, I mean, I agree with Seiboon. I mean, I think with the US and China, you know, the inflation rate, I think is going to stay high with pressure on the supply chains. And you know, there's that saying, like, when the US sneezes, the rest of the world catches a cold. I think like that's now applicable to China, right? Any slowdown in the Chinese economy is going to be felt throughout the rest of the world. And in terms of their policy, I mean, you know, we don't really in a place to like debate it, but I think they've really kind of put themselves in a corner because now they have to really see this through. They have to see COVID-0 through. And if it does get to the point where it starts becoming, you know, outbreaks and they can't control it in China, that for me is also another danger sign for the market, Chinese stocks and market and the consumer sentiment in China. So that's for one big reason why I'm more comfortable in the US market, is because the US has already accepted it as endemic. So from that perspective, there's not that threat to the economy, the real economy, the consumer economy. In terms of the market, I think, you know, as Seiboon said, it's actually not terrible with rate hikes. I think what's going to determine the market more is probably the tightening and the rate of tightening of the balance sheet, because the balance sheet of the Fed has expanded to sort of like 9 trillion, right? So that's doubled from what it was pre-pandemic. And I think the runoff of the balance sheet is going to really determine where the money flows, and if that sort of rotation into value kind of stays, stays and sticks. And if growth just really doesn't get a bump up this year, or it doesn't come back, because I think that's really the amount of liquidity into the market, obviously over the past 2 years, has really helped support prices. So I think it's going to be important to see how they signal how fast they're going to run off the balance sheet, as opposed to just saying they're going to put 3 or 4 rate hikes. I mean, that is important, but I think the balance sheet's also something to watch.
Okay, cool. So the tightening is something that we need to pay close attention to. Okay, Sebun, you gotta stay with me for a while. There's another question that talks about, do you think there's a possibility that we will face with an inverted yield curve, given how fast the front end of the US Treasury yield curve is rising?
It is possible. We've seen the yield curve flatten, but it is not flattened by any means yet. We would have to see very aggressive increases in the short end. All right, look, in a nutshell, I'm thinking through this. We will see progressive flattening of the yield curve through this year. Will it go negative? I don't think it will go negative for the first 3 quarters. There is a risk towards the end of the year. There is a risk towards the end of the year as the rate hikes kick in and the short end starts going up. And then then that sort of changes the market's sentiment towards growth. Then your 10-year starts going down, right? So yes, there is a risk. We'll see a flattening through the next 9 months as interest rate hikes bite. Will we see it invert? I don't think it'll happen until late in the year, until the 4th Q.
Okay, I hope that answered the question. Okay, this one is for Tim, I think, because I think, Tim, you mentioned about C being one of your list topic, I guess. It talks about, despite the high revenue growth, C has been unprofitable and their net income is in losses. Shouldn't a good stock deserving a high share price be at least moving towards a positive EPS? Any comments on this?
Sorry. Yeah, no, I mean, this is a good question. I think this is something that a lot of growth stocks are kind of dealing with at this point in time, obviously with interest rates rising and cost of capital going up. But I think they've really proven themselves, their track record. If you kind of dig into the business a bit more and kind of see where they're actually profitable, they've already turned profitable in sort of Malaysia, Thailand, and Taiwan on the Shopee level. They're investing a lot of money. So I think this is why they're going to continue to run losses probably at the Shopee level for another like 1 or 2 years at least. I think that in terms of where they're going to turn profitable, it's been pushed out, sort of like 12, 18 months. But I don't think that is something you should worry about given the size of their cash holdings. I mean, they've got over $11 billion. They raised, the timing of the management is just impeccable. They raised about $6 billion just before rate expectations sort of changed, right? Shifted. So they raised at a really good price, and they raised money when they didn't need to raise money. And so what you are seeing with a C is you just have to, this is something you have to trust management on execution. And they've executed, so far and over the past sort of 3, 4, 5 years, just impeccably, right? I mean, they were nowhere in sort of 2015, 16, and then they overtook Lazada to become basically the #1 e-commerce platform in pretty much all of Southeast Asia. And they've got a cash cow in Garena. So that's something we shouldn't forget either, is that there's actually a really profitable business in the online gaming space. They do have Free Fire Max, which just came out. That's starting to garner more traction in terms of users and paying users. So there's more skin, there's more optionality, there's more availability for to monetize users. And I think this is sort of like an Amazon story, right? Amazon wasn't profitable for ages. So this is kind of thing where it might not work out in sort of 1, 2 years. If you really believe in the business and hold it long term, I think it will work out in sort of like 5 to 10 years. And it's something that has delivered on a consistent basis in Southeast Asia, and it is really sort of taking a really, really big lead. And there's so much optionality, which is what I love. So when I talk about businesses and these kind of game-changing stocks, they have optionality. And so you think about advertising, like Amazon now is starting to gain about 3.5% of its own GMV from advertising. And so advertising is just at the early stages with C. So advertising is incredibly high margin. It's incredibly high margin because it's basically free, and it's all like, it all goes down to the bottom line, right? And they've just started doing that with Shopee. So the amount of monetization potential is sort of, there's so much optionality with the business that I think you will just have to sit through this. And if you don't want to, that's fine. I mean, like, there's people that just don't want to hold these loss-making businesses, and that's cool. And so, but I think the growth for me in this region at the e-commerce level and at the gaming level globally is just, yeah, too exciting.
Okay, the size, the cash, the management, as well as the options to monetize is one of the key factors that you look into. So that answered the question. Okay, this is probably for Samuel. Now, Hong Kong has been badly affected, I think, especially last year. Could it recover to its previous high, or is China continue to suppress Hong Kong and that they will never recover to their past high? Any comment on this, Samuel?
I would think that, like we shared, Hong Kong sort of like corrected severely last year because of the various regulations in place, like example, debt on tech. But that being said, our analysts, our CGS-CIMB Hong Kong research analysts are actually feeling that it may be the bottom. Why is that so? Is because of the fact that if you look at last year itself, there was if we compare the number of share buybacks last year, whereby companies feel that their share price are at its lowest, it's actually comparable to, it's actually the highest since 2008. So this is actually something that they feel that markets are actually factoring in the various consequences and are feeling that it is time for recovery to take place. Second thing, if you look at it, the government, like stated just now, has sort of like certain support measures in place. So we can see like the banks, the Chinese banks, they have are sort of like lowering the RR. They have actually also, you can see that certain measures that were put in place this year by the Chinese government that were actually supportive of the property market and the healthcare sector as well. So all of these are points that markets will see positively. And we see that for the Hong Kong markets itself, this year thus far, it has been doing quite well as well. And so I mean, as in going back to the previous high is something that is people will look towards in the long term. But I think at least in the near term, it's still finding certain support. And people are slowly looking towards it that it may be a recovery play in place because the worst may have been already over last year. Yeah.
Okay, basically the worst has been over. So do pay attention on the Hong Kong market. All right, I think I'm just going to pass this time to Monday because I think just want to take the one on dividend because we don't have Indonesia and Malaysia, so I'm just going to skip that first. And we try to collect dividend stocks as defensive play. What's the top 3 factors, the companies that could lead to consistent high dividend payout? I think Manji, probably Tim and Seibun could also talk about this. But yeah, let's just get money first since the REITs are a lot on dividend play.
Yeah, hi. I think, well, REITs have to pay 100% of their earnings to enjoy the tax transparency. So I think, it will consistently generate high dividend yields, particularly currently when the whole sector is offering about an average of 4.9%. But if you look at stocks specific wise, it can range, anywhere between 4 to even as high as 8%. The key is, looking for those that offer growth as well.
Growth in the REIT sector, correct?
Yes, in the earnings.
Seibun, you want to add anything on this or?
Yeah, sure. Look, I don't want to get into the theory of what companies have to do to generate dividend. It's just good cash generation and good management. And but look, I just like to look at the income side of things in terms of the value plays that I've been looking at. So for example, if you look at the Japanese market, you've got some really high dividend paying stocks up there. You've got, well, arguably a tech stock, like a Nintendo, right? And it's paying you what, 3 to 4% dividend yield for what is arguably a tech stock. So I was just saying how Nintendo is likely to perform. I was talking to someone about this and I said, well, it is a tech stock. And he said, no, it's a value stock. So go figure that out. And you've got value situations with very high dividend payouts amongst the energy companies, right? So, and I said I did like the energy. I like the energy companies since mid 2020. So it's been a long time. Now they are paying a heck of a lot of dividends out because of the pressures of ESG. So they are not investing a heck of a lot of cash. They're just taking a lot of cash where the price of gas, price of oil goes up. It all just comes in as free cash flow. So, so look around. So there are many of these opportunities in these value sort of opportunities. So I don't want to get into the theory of how to manage a company, but look for these opportunities.
Yeah, I would just add, for me, I mean, three things are, sort of the first and foremost, sort of cash flow, just that phrase, cash flow. Make sure the company that you're buying, if you're buying it for dividend, has, really strong free cash flow and really strong operating cash flow, because that is really going to fund the dividend and the payout. Secondly, I think it should really have a low payout ratio. For me, I like companies that are not having to pay out sort of, unless you're talking about REITs, because I think that's just what it does. It delivers that kind of thing. But if you're talking about a stock or a company, I don't want a company that's paying out like 70, 80, 90% of its sort of net income in dividends. What you want is that runway for it to continue to grow the dividend. So, a payout ratio of sort of 20, 30, 40% is nice. And the yield is not so important to me, because if they can grow that dividend fast, then that is much more exciting as a long-term hold, because you can kind of see that cost basis or yield on cost basis, like sort of, increase over time. And then finally, it really has to have earnings growth, right? You have to have that sustainable earnings growth, and it has to continue to deliver year after year. And there are lots of companies in the US and in Asia that you can find that kind of structure. So yeah, that's all I'd say.
Okay, great, Tim Zebun. All right, this one will be for Sesiang, the market after my very own heart. After I'm from Malaysia. So any opinion on Genting Berhad and Genting Malaysia? It's very specific, Sesiang.
Yeah, definitely not my specialty. Let me just share screen. One sec. Yeah, so you can find Genting. I think for our analyst, he thinks that Genting is nearing the end. There is a light at the end of the tunnel. So potentially you could see a turnaround for Genting. Genting Malaysia and Genting Singapore very much has got to do with the recovery play, as all the restrictions are slowly lifted. And so you probably see better performance for Genting Malaysia and Genting Singapore for 2022. So I think that is our analyst outlook for Genting Malaysia and Genting Singapore, which in turn will boost to Genting as the mother company or the holding company.
Yeah. Okay, thanks, Sesiang. Okay, I think this is back to Zebun as well. Gold is a natural hedge for inflation, but we are seeing gold price falling or interest rate hikes with interest rate high expectation. I guess
not true. We just saw the XAU USD surge in the last few days. It's now doing about $1,826. So yeah, look, indeed, I see Bitcoin, the BTC, getting support from that 40,000 level. So I still am reasonably positive towards gold as a hedge. And if you look at the ratio of the XAU USD, right, versus the Bitcoin in USDs, if you look at the ratio, we have seen a bottoming out of XAU USD versus BTC USD. And in the last few months, gold has obviously outperformed Bitcoin. But that said, I think we may see Bitcoin start coming back a bit. So I don't know, but I still like gold as an inflation hedge. So I disagree with the idea that, yes, over short periods of time, rises in the nominal US Treasury yield, whether it's a 10-year or the 2-year, can dampen sentiment towards gold, right? But the bigger cycles, I go back again, it is what inflation does to real yields. And I think that's going to be supportive of gold this year.
Okay, I think the focus should be on what inflation does to the real yield, right?
Absolutely.
Right. There is another question. I think this could goes to either Sabun or Tim, or actually any of you guys. When is the right time to go into growth stocks, right? I mean, you talk about it being priced in, right? So the 4 rate hikes expectation have been priced in. Maybe you can start, Sabun.
Look, as I said, look, Tim talks about growth stocks as 10-year sort of opportunities. I don't have any arguments about that, right? But if you are looking at it for the next year or so, I would prefer to be, let me be polite and say I would prefer to be in value stocks.
Cool. Tim, any comment?
I think it's just important from a growth perspective to be buying quality in this point. You know, I think a lot of these growth stocks have come off sort of 50, 60%, but there's been a sort of indiscriminate sell-off, right? So there are companies like, say Zoom, which we're using now and which is used every day, that people are just saying it's a pandemic play, it's a pandemic stock. Yet it's got an annual revenue run rate of 4 billion and it's profitable and it has gross margins of like 75%, right? So I think there needs to be a bit of discerning in terms of where is the cash being generated, you know, because I think if you look back to 2000, there was companies that were being valued at whatever multiple on basically no revenue and the idea. Whereas now these are actual businesses that are generating revenue and they're generating profits. So I think it's a completely different sort of picture from back then. But I think for one thing, it's difficult to say with the rotation. I mean, no one can tell when the rotation will be over or if it's going to continue for a long time or, you know, because of inflation and because of profits in the here and now. But I think from a lot of the other sort of value names, like the structural story is difficult. So, I mean, Sabun was right that they do pay out a lot of dividends now because the investment is under pressure. So they actually have a lot of free cash, which is great. But longer term, how are they going to pivot to a world which is going to be focused on, you know, limiting the carbon footprint? And they do have ideas and they do have ways that they're trying to pivot to clean energy, but that is going to be a multi-year project and it's going to be extremely difficult to execute with the amount of competition that's going on, right? So I think it's a bit more nuanced maybe, but I think some of the really high growth names have taken I mean, they're off like 60-70%. So I don't think it's a bad time, but you have to be selective. So that's what I would say.
Okay. Now, due to timing, I don't think we can take out all the questions that there are there, but I'm just going to end with one last one for each of our speakers here. Just basically, what's the biggest risk that you see? I think among our speakers, most of you have been quite positive on the market, except probably for Sexiang. So I guess maybe you guys could just maybe start from Sabun, just talk about what's the biggest risk that you see for 2022?
The biggest risk that I see for 2022 is just the valuation. So, and which is why I'm not bearish across the board. I'm just simply saying look for better value, because I'm seeing when you look at the US market, whether you look in terms of the forward PE ratios or you look at the so-called cyclically adjusted PE ratios, it's very expensive. It's only been exceeded by year 2000, just before the NASDAQ crash, right? So this is not a cheap market. And when you have a market that is not cheap, I won't say it's a bubble, but it is just not cheap. And when the discount rate goes up, right, it means that the price that you should be paying actually goes down. So you get this divergence between what should be fair value and what is the market value. And that divergence becomes at some point rather difficult to continue with. So the biggest risk is quite mundane, is actually valuations. And people talk about COVID-19. I think that will be less of a risk going into 2022. It's a tough one. You know, we're all playing amateur epidemiologists, but the science is telling us that, and I just had a look at the data, the number of cases has gone through the roof in the US, everywhere. And the number of people in hospitals have also gone through the roof. But interestingly enough, the excess death, the number of people dying now compared to this time over the last 3 years is actually gone below normal.
Okay. All right. Thanks, Abun. Tim?
I think my biggest risk will be the Chinese economy and the variants in China. I think they, as I said, they kind of position themselves into sort of this corner where they have to control it. It does have I think there's popular sort of support for the policies, right? So I think this is going to really drive how they manage this crisis. But as we've seen globally, this thing gets everywhere, right? So this is very, very highly transmissible. So if the Chinese government can control this, I will be extremely, extremely impressed. If they can crush this, this variant, I'll be really impressed. But I think that the danger is that they won't be able to, that they'll start shutting things down. Supply chains will become even more constrained and more strangled. Inflation will rise. So I think I'm just, playing devil's advocate. I'm just thinking what could go wrong if things go, a bit pear-shaped in China and the Chinese government starts really clamping down and starts shutting things down. So I think for me, the biggest threat to the global economy is something happening in China where it gets a bit out of control, because they do want to control hospitalizations, because hospital beds per 100,000 on a per capita basis is much, much lower than the US and Europe. So they do not want a situation where hospitalizations spike. And their whole sort of strategy is, basically gone down the drain. So I think it's a bit more of a fine balancing act. And I think that's going to be one of those risks that maybe is not so obvious front and center right now in the new year, but I think is going to be something to watch play out over the next sort of like 3 to 6 months.
Okay, cool. So Chinese economy is one of the biggest risks for Tim. Samuel?
Well, actually, I beg to differ from Tim. but
cool. We want some different opinions here. Yes.
Yeah, but what I feel is naturally is the attitude towards the various governments towards COVID as a whole. So, like example, we can see that even though Chinese government is having a zero tolerance policy, they are taking a slightly different approach from when they initially first locked down back in 2020, and they are much more opening to having sort of like control measures on the various clusters. But what I think that going forth that people will be looking towards is really the reopening play. When will countries be comfortable to reopen their various economies? And when can we really coexist with COVID? Because I think that every time a new variant comes into play, the various governments tend to panic, and we can see like closing of borders or like example, tightening of restrictions once again. So I think it's more of like the mentality approach and how the various governments or work together globally to actually ensure that there's safe reopening. And when we actually live with COVID in the long run, then naturally you can see that things start to work out and people start to be more positive about the overall supply chain, the overall transferable of goods and services, as well as the overall economy and people's consumer confidence. That's what I feel will be the biggest thing to look out for in the upcoming year, is the attitude of the various governments towards handling COVID in a global landscape. Yeah.
Okay.
If I can just jump in there to just add to what Samuel said, I'm not concerned. I'm not so concerned about the Chinese economy per se. I mean, there will be risks, and we don't know what we don't know, obviously. But if you look at the way the mining companies' share prices have been performing, if you look at the massive rally in the iron ore futures in the last 6 weeks since the start of the year, and you've seen stocks like Fortescue Metals Group, it's gone ballistic. You've seen Rio Tinto go ballistic, but there are supply side issues there, to be fair, because Vale has had some production problems in Brazil. But it's not just a supply side issue. It's also because the Chinese are stimulating the economy. The Chinese have gone from restraint to go spend it now. This is part of your KPIs, right? And this is what they call cross-cyclical policy, which is just a new word for counter-cyclical economic policy. So I'm reasonably optimistic about the Chinese economy.
Okay, Seibun, I think you have your time. We're running out of time. Just FYI. Sorry. Okay, Sesiang, your turn. What's the biggest risk for you on the Malaysian market?
Well, for me, being a technical guy, it's not that important to know which are the factors that's gonna affect the market. So I just let the market do what it does, and when it breaks out the key levels, then I think that's a good time to get in. So like, as I mentioned, it's gonna lift all boats, big and small. So once it's above the key levels, I think it's good enough to get in for most stocks that are doing fundamentally okay. Yep.
Okay, cool. So don't get swayed by the market. Wait for the key entry level to go in. All right, Mani, you get the honor to do the closing. What's the biggest risk? Yeah.
For me, on the REIT sector, I think the risk is inflation. I think, as Seibun says, the market has priced in to a certain extent, say a few rate hikes this year. But if inflation continues to persist and pressure on the long end of the bond yields, and we see that eating into the yield spread for the yields for the REITs, so that would pressure on valuations. I think second thing is any outbreak of, say, a new variant that would prevent borders reopening. So that would mean that a potential for upside risk in earnings growth could also be lower.
Okay, thank you, Mani. So thank you to all our 5 speakers here tonight. Thank you everyone for joining us, and sorry for the slight delay. Have a good night, everybody. Bye.